globalization. So today we're going to be looking at kind of the history and current practices in central banking and some of the outcomes and errors, the fixes that we try to do as we manage major economies and financial disasters. And we will conclude by looking at the effects of the Great Depression and kind of how the U.S. government responded to this international financial crisis. And this has really then become the model for how central banks and governments have responded to any financial crisis after that, and which we will be also looking at in the coming lectures. So let us begin by sort of examining financial systems and how central banks and banking and trade has played a part in the structuring as well as the fixing of financial setbacks, as well as sort of creating how we do business within this modern globalized world. So the reason that you have the development of banking is largely on account of trade, and you've seen this slide a couple times, but trade is just simply the work of buying and selling, and within trade it is the goal is to benefit both parties, that everybody gets a good deal. And within these trading relationships, you create commerce, and commerce creates wealth, and wealth builds civilization. And within this matrix of trade, we have to have exchanges of monetary goods. We have an exchange of physical goods, but we also have to have an exchange of money. And how you do this it can be quite complex, and over the course of time, it has developed in many different ways of how nations, businesses have structured trade policies, and how that they have exchanged monetary value for goods. So this was originally done by merchants who were sort of individuals or who worked for rich families, and they would go out and they would find markets, that they would find goods, and then they would exchange them and try to make a profit. So always within trade, you have this element of risk, that you are taking a risk when you buy something and you try to ship it somewhere. Your cargo can be destroyed. And it was certainly the case in pre-modern times, and it has been mitigated to a degree with the advent of insurance in modern times. But ultimately, it's when you begin in a system of commerce, it requires people going places, finding markets, and making deals regarding these goods that are going to be exchanged, and then the ultimate goal always being that there is profit made for the middleman, who is the merchant. So I say markets. So what ultimately are markets? Basically, a market is a safe place that you can go and do business in the pre-modern world. I mean, it's literally a place where you show up and you do business. And often now we talk about markets as being sort of these places that we can go and speculate about goods and where we can exchange things, or we can provide services and goods to or from, that we have to find new markets to where we sell things. So it often means, we're going to market our goods in a certain area or region, a nation. But it can also just simply be a place that we go to transact business. So there's still this element of having to have good market conditions in order to do a lot of trading and banking. So markets have to have a degree of luxury, because these are rich people who are coming together. And so if you want to have a really good market, a market area, a place for people to do business, you have to, in the ancient world, it was the same as it is in the modern world. You have to provide very good facilities. It needs to be safe. There needs to be low tolls and exchange rates. And it needs to be sort of located centrally. You're not going to go into sub-Saharan Africa to negotiate a deal. You would go to a London or a Brussels or Shanghai, right? These are centrally located places where the rich and wealthy live very often. So banking originated with very wealthy families. And these wealthy families would then loan out money to people, and they would make private deals with private individuals, and they would charge interest on loaning out this money, and they would of course generate a profit from their loans. And this is the origins of banking. And within banking, you have this problem. So if you have gold coins that you loan to someone, it's very easy to get robbed, and bandits or various nefarious individuals will be able to steal the gold bullion if you carry it with you across hundreds of miles of territory. So the banking industry develops a note of credit. So you could go into the Bardi Bank in Florence, Italy, and you could bring your gold coins in, give it to their bank. They would issue you a note of credit, and then you could take that to any of the Bardi branches, bank branches, anywhere across Italy in the Middle Ages, or you could go into Northern Europe, and you would show up at that bank, and you would provide this note of credit, and that they would then issue you your gold coins in Paris or London or wherever that you were doing business in. So it's much safer. Because you can't, it's much harder to get robbed when you have a note of credit rather than a bunch of gold coins. And it's also much easier to transport. And then you have this thing called a check or an exchange, or bill of exchange, in that instead of you taking your gold coins, giving it to another merchant, you can just simply give them a piece of paper that says, I authorize my bank, the Bardi Bank, to give you the set amount of money that I have designated here. So that's another way of promoting easy, good, and efficient change. So this is a practice that has continued on into modern times, in that we have a currency that is developed by banking systems. So these are private banks. So this is the origins of the banking system. But banks that are private, and really within the United States, you basically have all private banks. So they have bank charters, but really all the banks in the United States are still private, and it's just simply owned by a group of investors or a board of directors that controls this bank. And banks make decisions when they are larger institutions or even smaller institutions, what they are going to sort of invest their money into. So if you come to borrow money from a bank and you want to have a business venture, the bank is going to measure the amount of risk that it's going to take. Are you a good credit risk? Have you paid your bills? How much money are you asking for? What is the kind of business you're going into? And they're going to measure risk. And they are going to then give you a loan, and if you're a bit higher risk, they're going to ask for more interest on the money. If you're lower risk, you're going to have less interest on your money. So in the earliest banks in the United States, they're all private institutions. There's really no oversight within these things. That they all printed their own notes of exchange. Remember, I said if you went to the Bardi Bank, you could go to any Bardi Bank, but you could not go to any other bank. It just simply works only for Bardi banks. Well, the same process continues into the 1800s and throughout the West, that private banking institutions issued their own notes of exchange, their own money, their own paper money that gets value from the gold or the bullion that these banks hold, and that you could exchange your paper note for. More on that later. But ultimately, if a bank fails and you have your life savings in it, there is no redress for you because the bank has lost all your money. And there is no FDIC program where the federal government is going to insure your money. There's no way you can sue them because you have put your money in this bank and the bank has simply failed. So you can see the problem here with some of this, that as corruption or bad business practices cause collapse, and many people could lose their life savings. And also, as a bank prints its own money, its own notes of exchange, then this is only as good as the reputation of the bank in the area. So you could not take your notes of exchange from New York to Arkansas and probably with any success be able to exchange them unless there is branches of that various bank. So it's difficult to measure the effectiveness of this paper money. But when you don't have a standard national currency or international exchange rate, it's very difficult to determine the value of the money that you have if it's paper money from a bank. So it's easy for corruption and collapse to happen within these kinds of systems because there's not a lot of oversight. Case in point, one of the most famous bank runs and collapses was on the Knickerbocker Bank and Trust Company. So this is one of the largest banks in New York, and basically the Knickerbocker Bank creates a panic in 1907. And this is the famous panic of 1907 that sort of institutes the Federal Reserve. But the bank runs out of money. It makes some bad decisions, and therefore it's a huge bank. And many people had kept their money in there, and therefore when they began to wobble, to sort of people lose faith in the institution, everyone runs to this bank and tries to take out their money as fast as they can, because there is the belief that the bank has all the money stored up in the safe that you had ever put into this bank. Rather, the bank has loaned out this money to many other people, and they just simply have a massive liquidity crisis. So when people can't get their money out of the bank, then there is massive panic. Everyone withdraws all their money, and the bank collapses. So this brought on the panic of 1907, because one major bank failing often makes everyone distrust the bank system in a regional area. So everyone goes and tries to withdraw their money. And this caused a regional collapse in banking throughout the eastern part of the United States, from the New England area. So this was so bad, the panic of 1907 was so terrible that Congress decided that it would intervene. And this is in a time of economic liberalism. And I mean liberalism with a capital L, that really the federal government had no place in business, was the ideology, right? Laissez-faire economics. But it was so terrifying, the panic was so bad that Congress decided that it would indeed intervene. And what does Congress always do? Well, it convenes a committee. And Senator Aldrich formulates a plan within the committee that was put forward in 1908 that they should have a central bank. Now, the United States had central banks before, but Alexander Hamilton famously was able to create the first national bank, and then there was a second national bank, but ultimately President Andrew Jackson disallowed the continuance of the federal bank charter, and the United States had not had a federal bank system managed by the government or overseen by the government since the 1830s. So anyway, the Aldrich Plan was the introduction, ultimately, of the Federal Reserve banking system, which came to fruition in 1913. So the Federal Reserve is not a national bank per se. It's a hybrid banking system that is designed to be both a private and a public institution. It's a very curious blend of the two. And it is paradoxically at the same time, it's a central banking institution, and it is also a regional banking institution. It is overseen by a board of governors in Washington, D.C., which are public officials that are appointed, and then you have sort of 12 regional banks that are run by their boards of directors that throughout the United States. What was the goal of the creation of the Federal Reserve in 1913? Well, ultimately, the main goal of the bank was to become a lender of last resort. That if the Knickerbocker Bank and Trust Company was going under, they could retreat to the Federal Reserve and say, "Please give us more money, and we can stop runs on the banks." Now, these loans that the Federal Reserve would give to these banks were not free of charge. They were quite high interest rate loans, so therefore you would only turn to the Fed in the most dire needs and times of greatest fear, that you wouldn't abuse the system in this way. So ultimately, the job of the Federal Reserve is to stem panics and stop a collapse, systemic collapses of banking systems within regional areas. And even the Fed is designed, as I said, with 12 regions throughout the United States. So even they felt if one area, one of the 12 regions was really hard hit, that the other banks could continue to prop up the others within this system, and that would not have a liquidity crisis across the entirety of the nation, and that other regions could prop up hard hit areas. So as we talk about the Fed and sort of quasi-national and national banks, generally speaking, central banking is the government bank, and the government, through this institution, issues bank notes, which is currency. So the U.S. dollar is the currency of the United States. It is issued by the Federal Reserve banking system. The central banking system has the ability, through the manipulation of its currency, to inflate and deflate the markets and the value of its money. So in the event that you have economic crisis, the Federal Reserve Bank, or any central bank, can print more money. You can keep more and more money, as John Maynard Keynes argues, that you have to have a massive amount of liquidity within your particular nation in the event of economic downturns, because this is ultimately what causes recessions, is a liquidity crisis. Now, whether that's true or not, I will leave for the economists to debate, but that's the theory. So the Federal Reserve can print a lot of money. It can keep interest rates low, because when you borrow money from the Fed, that is what determines whatever rate that everybody else is going to get. If the Federal Reserve rate gives money, loans money to private banks throughout the nation to do business at 1% interest rate, which is incredibly, stupidly low, then these banks are going to charge you 2 or 3% on your loans, because they have to make money. So if the Fed charges 10% to a regional bank or a private bank, then this bank is going to charge you 12 or 15% on your loan, which is a pretty high interest rate. So it encourages you not to borrow money at a high interest rate. If they lower the interest rate, it encourages you to borrow more money and spend more money. So by printing more money and keeping central bank interest rates low, It encourages spending and economic growth through a lot of borrowing and cheap money. But by doing this, it also makes the currency less valuable overall because there's a lot more money in the system. It used to be that this was tied directly to gold, but now it's simply based upon sort of inflationary rates that are adjudged by the value or the money supply. So if you print a lot of money, your currency gradually becomes less and less and less valuable. Now, this might be thought of to be bad in the sense, oh, the U.S. dollar is very weak. But at the same time, when you make a currency weak, it's cheap internationally for people to buy your stuff. So in a national economic sense, if your money is not very valuable, no, you lose spending power at an international level, and things cost more due to inflation in your nation, but also it tends to allow you to grow your economy, and therefore you will eventually get your money will become more valuable because your economic situation internationally has become better because everybody wants to buy your goods because they're very cheap. Now, if you want to make your currency stronger, you want to increase the value of the U.S. dollar, then you have to sort of call in some of this money. You have to bring in some of these loans and things like that, and you have to raise interest rates and encourage people to save instead of spend. So you deflate your amount of money, and therefore the U.S. dollar would become more valuable. And this is not a popular theory, although this was a one that was before the Great Depression, that you needed to have very strong national currencies. Also, as these interest rates that the Federal Reserve sets also creates an interesting situation for private banking. And because the Federal Reserve is not a national bank and doesn't own all the banking institutions all over the nation, it allows for banks to enter into the private market. And therefore, you can buy these things called certified deposits from private banks, which is often referred to as a CD. So if the Federal Reserve's interest rate is at 10%, which is stupidly high, a private bank might offer you, as a private individual, the opportunity to give it money, that it's going to take your money instead of the Federal Reserve's money, or its loan. You're going to loan the bank money, and the bank is going to pay you. If you allow them to use your money for 5 years, the bank is going to pay you 4% on your investment in the bank, or 5 or 7, whatever they might deem. And you can give them your money, and you can generate quite a bit of interest off this if the Federal Reserve rate is high. So it encourages you to save. It encourages you to invest in very safe and not risky things. And the same with your savings accounts and things like that within banks. They will pay you interest rates for you to leave your money in these accounts, so they can then use your money at a cheaper rate than if they borrowed it from the Federal Reserve. So there's a lot of give and take you can see here, and this works at a national and an international level, but it's ultimately determined by this sort of central banking system. So the first central bank that we really see here is the Bank of England, and they are the first to extend credit at a national level. And what the Bank of England really does is that it creates a national debt for the first time, that the bank allows private individuals invest in this bank, and they are going to get rates or they're going to get returns on their money. So you can loan the Bank of England a large sum of money, and you might never get your original sum back, but you're going to get a perpetual annuity paid to you for your investment in the bank at 7% or 10%, whatever it might be. They're very high initially. So when you read the Jane Austen novels, these people in the 1800s, these characters in these novels, they often talk about, oh, he gets 5,000 a year or 10,000 a year or whatever. So at some point in the 18th century, one of these people's family members has given the Bank of England a very large amount of money, and therefore their family gets a perpetual annuity from the Bank of England for a certain amount of time for their gift of this loan. And the principal would maybe never be paid back, but you would make much more money over the long term, and the bank gets much needed capital in order to finance things like wars. But the Bank of England is the first bank to sort of create this notion that you can create a national debt by having your own citizens and other people, companies, corporations, other nations investing in your central banking system. And they are able to become a very strong institution because of this, and this is one of the main reasons that Great Britain becomes the imperial power that it does, is that it has so many innovations within its banking system, that a very small nation is able to create this financial system that allows it to become the premier imperial power by 1820, 1850. And the British pound sterling is sort of the first international exchange rate / reserve currency. And this means that the world determines its value based upon that of the pound. And the pound sterling was officially tied to the gold standard, which we will discuss more in a later lecture, in 1844. What this means is that your banknotes issued are directly correlate to the amount of gold that you have in your nation, or at your disposal at your institution. Because gold is a thing that you can't really manipulate in the way that you can currency. You can't just print more gold in your bank. Rather, you have to dig more gold up. It's very hard to get, and it has a value, an intrinsic value that does not fluctuate very much at all. Whereas if you print a lot of banknotes, they fluctuate enormously in value. Can't really do that with a gold standard. But nevertheless, the pound is tied to this gold standard. And based upon this rate of exchange, if you wanted to do business in France, you would say, I will pay you I will pay you £1 for your bottle of wine. And 1 pound is worth, or 1 ounce of gold is worth 1 pound. So if a franc is worth, if they have deemed their currency worth 5 francs are worth 1 ounce of gold, then therefore you have just agreed upon a standard that the British pound is worth 5 francs. 1 pound to 5 francs, based upon this gold standard system. But it's much easier, rather than carrying gold all over the place, just to simply have sort of a world reserve currency, or an international exchange rate based upon this currency. So until World War I, the British pound sterling is sort of this international exchange currency that everyone doing business did business in pounds, and that gives a great advantage to England, because it forces everyone to have to have pounds. So you have to get these banknotes from the Bank of England. You have to use their currency, and therefore you have to give them money in order to get their currency and be able to exchange for goods on a worldwide basis. So it's an enormous advantage to have your currency as the international exchange currency. And today it is the U.S. dollar, because after World War I, the British kind of physical hegemony over the world begins to wane. And the United States is this protected industrial colossus, and that had not been destroyed or borrowed enormously during the war. Rather, it was the warehouse and factory for all the nations in World War I. And gold and money and debts to the United States soared enormously from all the other European nations, and therefore the United States began to be the lender of choice rather than Britain. And the U.S. dollar begins to emerge as sort of the supreme currency. Very draconian war reparations were placed upon Germany following their surrender in World War One. And ultimately, because the Allied powers, the French, the British, demanded enormous amounts of war reparations be paid, and be paid very quickly from Germany. Therefore, the Germans they had just been defeated in a war. Their economy was broken. They had no ability to pay back these massive war reparations, which were up to $30 billion, and this was 3 times their own GDP, their gross domestic product of their economy. They had no way to pay these debts, so they just turned on the printing machines and printed up as many Deutschmarks as they needed to. And it just ultimately the money just becomes utterly worthless, because again it is tied to the amount of paper money in circulation, but it is also tied to a gold standard in these times. And ultimately it comes to that 4 trillion, that's right, trillion with a T, 4 trillion Deutschmarks in 1923 equaled 1 U.S. dollar. You heard me right. 4 trillion Deutschmarks equals 1 U.S. dollar. That is how worthless that the currency was. And you can see here in this slide, they have a 50 million mark note here because it's just so utterly worthless that it becomes just a joke, to get a Deutschmark. And after the conclusion of World War I, France, Great Britain, because of their economic inflation, both returned very quickly to the gold standard, which was probably quite devastating. Most historians and economists argue that this is one of the main reasons that caused the Great Depression, was the return so quickly to the gold standard. So we have this question when you enter into international banking. Who sets exchange rates? What is the world reserve currency? How do you set these things? Well, it's sort of an arbitrary system that's based upon some international institutions as well as sovereign nation states, the amount of money in circulation, and it changes on a daily rate. So it's very difficult to sort of pin down, well, what is a standard exchange rate? Why is that important? Well, the gold standard theoretically allows that this floating exchange rate based upon the amount of money supply in the world of a various currency would remain very solid, very standard, and that it would not fluctuate very much at all. You don't have that luxury when sort of the United States dollar is the exchange rate, because, well, the United States can of course print as much as they want, just like Germany did following World War II, or World War I, excuse me. And we talked about how that it is the world reserve currency, and so everyone has to have U.S. dollars in order to operate within this system. So you need to purchase USD in order to do business. Everything is based, and an international exchange rate is based upon U.S. dollars. So if the United Arab Emirates buys oil from Iran, they don't exchange in their own currencies. Rather, that oil is bought and purchased by both countries, valued, bought, and purchased in U.S. dollars. So therefore, these countries must own large amounts of U.S. dollars, and the same goes for global corporations. And we have to ask ourselves, when international banking is happening and it makes exchanges much easier, ultimately, who is responsible for enforcing laws of international banks? So if the Bank of America breaks a law in Saudi Arabia, who punishes that foreign bank? How do you control these massive global corporations? Do you turn to the International Monetary Fund, to the World Bank? But even if you get a ruling within the international court, then who who enforces this judgment? How are these banks controlled at a national level? Well, the short answer is that multinational corporations and large banks can't be controlled at a national level entirely. Now, you can do certain things to encourage them to behave well, and you can seize their goods. You can do a lot of things like this, but global banking has become so powerful now that they're able to simply buy a small office in the Cayman Islands or somewhere, and corporations are able to just channel their money there. That is their global headquarters, and the rates, the corporate business rates there are stupidly low. 1-2% tax rate on their incomes, whereas the bulk of their business is being done in Western nations, and though they are going to pay their sort of international rates as in the Cayman Islands. So it's very complex how this all works. And then ultimately, how do you enforce a sovereign debt obligation? Say a bank has loaned Switzerland money, and Switzerland refuses to pay. Who is ultimately responsible for getting this money back? You can get an international ruling from an international court. Whoever the organization might give you a good ruling. They might say Switzerland has to pay this money back, but ultimately, without the force of arms, you could never force Switzerland to do that. You can make Switzerland's life uncomfortable and miserable, and they can lose reputation in the world, but ultimately, sovereign debt obligations are very difficult to enforce within an international banking system. So what role do governments play in our current economic systems? So historically, protectionism within economies has been the role of government. That there are certain industries that have been deemed so important that they merit national protections, meaning that nations will protect their agricultural base or their car manufacturing base or whatever it might be through the means of tariffs. And they will arbitrarily impose a 25% tax or excise tax upon the importation of all goods to their nation of this product. So if the Japanese produce cars, the United States is going to tariff that industry at 25% in order to encourage people to buy American cars that are cheaper. Now, the only problem with protectionism like this and not allowing free markets to do their job is that then, of course, Japan is going to tariff your product. And if you tariff Chinese products, China is going to tariff your products. And it sets off a trade war that really no one is a winner in, that is a consumer. And governments play a role of providing security, that business and banking cannot be done safely or with great courage and hope without secure property rights. If you believe that sort of a dictator is going to come in and seize all the money out of your bank and close down your corporation on a whim, then you're very unlikely to set up shop and do business with places and provide loans to investments in these areas. So governments have to sort of protect property rights and guarantee the security of assets of these institutions. And finally, and maybe most importantly, government plays a central role in regulating banking. Now, they might, to some degree, stifle banking, some would argue, but at the same time, unregulated, unchecked banking has led to many of the most catastrophic disasters in Western history. And therefore, a touch of banking that ensures that banks have a certain form of liquidity, that they have or a certain amount of liquidity, that they cannot provide just exorbitantly high interest rates for for loans, and that they can be predatory against the poor or the disadvantaged, that they have to have certain fairness within their banking systems, that you would have to extend loans to everyone, that you couldn't just loan Caucasians money, that you have to loan money to all ethnicities at the same and fair rates, things like this, that the governments can play a good role in making banks operate more fairly and efficiently to some degree. So the great question is not whether it should be an entirely laissez-faire system, capitalist system, or whether there should be a communist system where everything is managed. But rather, how much of this government regulation do you do? I think that's a much more interesting question. How much is too much? How little is too little? And ultimately, does regulation encourage banks to do better, or does it stifle the business operation? And I think we can see that government can be very useful in many instances in helping the banking system. That it can promote confidence in the system, that you can go and put your money in any bank in the United States because there is an FDIC guarantee that your money is going to be insured by the federal government, that no matter what happens to this bank, if the board of directors fails, the bank fails, your money is still safe up to $250,000. So this is a very positive exchange between the banks and sort of the central governing institution. Now, too much regulation can, of course, cause inefficiency within banks, and mountains and mountains of paperwork and various requirements can cause banks, in order that it takes 60, 90 days to get a home loan. This is not good if you wish for people to be able to borrow money quickly and to buy things within your economy. So there's a give and take here, and that's always the great question in economics. Now, it is possible in this day and age that you can avoid risk to some degree, that you can purchase insurance on your global markets, or on your investments, on your life, on your property, whatever it is, that you can insure something. So you can pay a company a fee, and if you die, they will then give your family money. You can insure yourself. You can insure your family as being taken care of. You can insure your property in the same way, that if your house burns down in the night, you don't have to pay to build a new house. You're not going to be homeless. Your insurance company is going to cut you a check because you have paid them $1,500 a year for 20 years to insure your house. Now, in all likelihood, your home is not going to burn down, but the insurance company gives you this safe feeling that you can make your trip out west, and you can come home, and if your house has burned down, they will build you a new one. And you can do the same thing within business, that you can insure your contract investments in things. And AIG famously did this, and then in 2008, and then of course they couldn't fund all the things that they had insured, and they collapsed too. So you can see here that there was negligence on their ability to cover all their obligations if there was a systemic financial crisis. So some of the roles and benefits of insurance within this system. Now, there's an old joke within economics that says, what's the difference between a recession and a depression? And it's very hard to sort of understand what the difference between a depression versus a recession is. And the joke is that the difference between a depression and a recession is when your neighbor loses his job. And a depression is when both you and your neighbor lose your job. So what have economists really suggested? What is a recession? What is a bubble? What are these economic terms? Well, when a country has a recession, it's when 2 quarters, so a whole half of a year that a nation reports two consecutive quarters of negative GDP growth. So everything that is produced in the United States of America, if it has a negative growth, we have produced less than we did in the previous 2 quarters. That is considered to be a recession. And for a recession to be transformed into the scary, scary word of depression, it has to be a decline within a year of 10% of GDP. So depressions are far more severe than recessions, and we will look just at sort of a case study here of the Great Depression. Now, the Depression in the 1870s was initially called the Great Depression, but the Great Depression of the 1920s, 30s was considered to be worse than the first Great Depression, so it got the new name, the Great Depression. So the Great Depression was the largest collapse of modern economics and test of economic institutions in modern times. And the responses to this great economic collapse have really influenced and shaped how all future responses to economic crises have been handled by central governments. So in 1929, the U.S. unemployment rate was at 3.2%. Markets were soaring. Everything was doing great. So by 1933, the U.S. unemployment rate was at 25%. And this is also a national figure as well, that in Germany, actually, they're even higher rates of unemployment, up to 40% in some of their industrialized areas. Britain, France, the same. So the U.S. actually has less of a hit than does many of the Western nations in Europe. And if we look at manufacturing in the United States, declines, manufacturing trades in the U.S. declines by 38% from 1929 to 1930. And it loses another 36% from that figure by 1931. World manufacturing declines 50% between 1928 and 1931. So this is a massive, massive contraction of world economies everywhere. Central banking in the United States, 40% of the private banks in the U.S. failed. By 1931, 2/3 of all international trade ceases. So this is a systemic and massive crisis that affected everywhere in the world, and it was quite terrible. So what are the reasons for the Great Depression? Well, there is a lot of arguments. I don't have time here to give you all of them, but we'll talk about a few of them. So most economists, most scholars think that the gold standard is really to blame. While the gold standard keeps prices stable, as we have discussed, it also causes the problem that you cannot devalue your currency, because you can only print so much money within this standard in order to keep your exchange rate fair within your agreements. So after World War I, almost all the gold in the world comes into the United States. As Europe returns to the gold standard, it is essential that they have certain amounts of gold. So France and the United States both undervalue their money based upon the exchange rate to gold. So therefore, their money is very cheap. So everyone wants to buy French and U.S. products. And all the gold in the world flows into these places. So you can see here in a statistic, 1927, France holds 7% of all the monetary gold in the world. And that just means gold bars that are used for economic exchange. By 1932, it has 27%. And when you have this amount of gold, everyone else doesn't have gold, and therefore they can't buy as much because their money becomes so overvalued. And Britain overvalues the pound. Everything in Britain becomes expensive, and you can see here how the gold standard, instead of keeping everything the same after countries undervalue, overvalue based upon their own theories, it causes anarchy within the world because everybody has to have gold, and therefore you scramble to try and get more gold, and you undervalue, overvalue, and it causes systemic problems within the system. So another theory of why the Great Depression happens is because of the Smoot-Hawley tariff bill. In 1930, really the U.S. economy only has about 5 to 7% of international trade. What this bill did is that it really caused an enormous crisis in speculation, and that's what a bubble is when people sort of believe they have confidence in markets, and then suddenly something happens to cause this to be reversed. And people get terrified, and they want their money, and they pull out of markets, and therefore this is just speculation. They lose confidence, and therefore the market collapses, and everything loses money because everyone pulls their money out, and everything declines. Everything is devalued. But Herbert Hoover, the president, or the candidate for president, runs on a promise that he will put farm tariffs in if he is elected president of the United States. And that's all he promises. And his promise transforms into this massive protection bill called Smoot-Hawley. And this bill, it has tariffs on everything, on manufacturing. Everybody's going to get economic protectionism from this bill. And so in October the 1st, 1929, this bill makes its way through the Senate. By October 29th, the market began to collapse. It had lost a third of the value. It causes a crisis in confidence because this bill went through the Senate. Though Hoover does not sign the bill yet. But there's more market fluctuation. The market recovers. It goes down. It recovers. It goes down. But ultimately, Hoover, he doesn't even want to do it. The famously Henry Ford comes to the White House and he later writes that he almost gets down on his knees and begs Hoover not to sign this bill. But nevertheless, Hoover doesn't want to sign the bill, but he doesn't also want to break his campaign promise. He signs it 18th of June on 1930. And this unleashes an international trade war against all the trading partners in the United States and the rest of the world. Because when you put a 20% tariff on whatever good, usually your competitors and your trading partners, they aren't just going to simply lie down and take this. They're going to respond in kind with their own tariffs. So in a trade war, no one loses, or no one wins. Everything becomes more expensive, and everybody stops buying other people's stuff, and there's a return to insular markets, and so international trade begins to fail. How does the Federal Reserve Bank, as it was created just a decade before, able to respond to the Great Depression, right? Its job was to stop the panics of 1907. Its job was to prevent systemic financial collapse. It failed in this. Between 1929 and 32, 10,500 banks out of 25,000 U.S. banks failed. Most economists believe that banks fail because of this. Remember this confidence that I talked about. When people begin to lose confidence in their market shares, the market begins to fall. They quickly flee to the banks and they withdraw their money. causing runs on the bank. The job of the Federal Reserve is to stop these kinds of things from happening because they can inject capital into the system and everybody can get their money back. They're going to feel safe because they've got that money in their hand. They're not going to lose their life savings because they've got it out of the bank. So there is a liquidity crisis. The Federal Reserve did not move its interest rates lower to bail banks out. It did not inject massive amounts of money into the system, and therefore, within this time period, within 1 year, there is a 30% contraction of monetary supply within the United States, and this causes a massive liquidity crisis. People can't get their money, and therefore banks collapse and fail because they can't raise enough money in order to pay back their obligations, and the Fed refuses to sort of bail them out. That they were very laissez-faire, that this is a capitalist system and you're going to play by the rules, that you screwed up and you're going to fail, that this will be the end of your bank because you overspent. And the government refuses ultimately to step in and bail out these failing institutions. And in the same way, people, working class people, have all invested in the market. They've put their money into banks that they believe that this market is going to continue perpetually. It's going to keep going up and keep going up, and they're all going to make money. They've overextended themselves. They've speculated on risky stocks, and they just simply overspent. People made bad decisions. We can look here and we can see the income inequality as well. And I think this is certainly worth considering, that in 1929, the level of income inequality, that the top 1% income earners in the United States is just about the same. That between 2009 and 1929, that the top 1% of earners in the United States in 1929 owned about 20 or made about 20% of their income, or the nation's income. That 20% of all the money made in the United States went to the top 1%. All is the same in 2009. So you can see perhaps a correlation between this massive disparity in incomes. And we're going to look more at this in the future. But how did the government respond to this, and how did this color other responses in the future? Well, the President Hoover did very little. That he was a staunch individualist, a staunch liberal capitalist, and so he did very little to intervene. And it was sort of the belief at the time that you shouldn't do anything, that this is how the markets work. Well, Franklin Roosevelt is elected president on the promise that he is going to use the government to help the private sector. So he's going to create massive spending programs, the New Deal, as it was, and he was going to pay people to dig ditches in the morning and fill them up in the evening. Didn't matter what you did, just as long as you were working. At least that's the argument. Whether that's a good idea or not is difficult to say. It might be better just for the government to give you money and let you stay at home, because then at least you're accomplishing something. Nevertheless, FDR introduces many new programs, such as Social Security, in that people would get a certain minimum level of money, a pension paid to them after they could retire, or incapable of working anymore. There were housing programs. There was the federal government tried to inject money into the economy, and also the FDIC was created, meaning that your money was insured, as I have talked about. Now, if you put your money in a bank, it's guaranteed by the government that they will pay it back to you no matter what. That even if the bank fails, it doesn't matter. You still are going to get your money back. And through these policies, FDR is able to sort of instill confidence in the nation. And they believed that this was good and that things were looking up. because of his new policies. Now, most economists would suggest that the New Deal and many of these programs really had almost no effect on the overall economic outcome of the Great Depression, but rather the monetary policy was key in that the Fed decided that it was reorganized and they would keep interest rates very cheap and they would interject a lot of capital into the system. And ultimately, it was the war spending that came out of World War II and the federal government buying a lot of industry goods that got the world and nation out of the Great Depression. So what were the effects ultimately of the Great Depression? Well, it grew government, made the government a much more prominent player within deciding the economic futures of the United States. And the federal government from this point forward was going to play a much more centralized role in managing the financial sector. And finally, it really encouraged that the central banking systems and the federal government had a role to play, that it would help and stop systemic financial crises. And it was the job of the federal government after this to ensure that in the event of a financial crisis that the nation would be looked after, and that it had to intervene after this point. And this has been the policy of every president and government since the Great Depression, really. And you can see here that largely these new ideas have worked, that there's been some hiccups along the system, but overall the amount of recessions since the Great Depression has been far less. So thanks for watching, and I look forward to seeing you next time. Until next time, stay healthy, wealthy, and wise.